Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Huge surge for the Dow, S&P, and the NASDAQ today. Welcome to Bloomberg Technology. I'm Emily Chang, sheltering in place in San Francisco. And today, Facebook, Tesla, and Microsoft all skyrocketing after hours as they all report better than expected earning results. Facebook saying they did see a significant decline in ads in the last 3 weeks of the quarter, but in the first 3 weeks of April, already starting to see some signs of stabilization. Also, Facebook blowing past expectations for users and ad revenue. Meantime, a drug from Gilead Sciences also showing some positive results that may have been giving investors some optimism earlier today. We're going to get to Facebook, Tesla, and Microsoft in a moment, but I want to bring in our Bloomberg Markets reporter, Taylor Riggs, first to wrap up the day that was. Taylor, huge optimism here. That said, we also got some data showing that GDP fell 5%. What's going on here?
I think that you sort of hit it on the head there when you said that people were already looking through the data in Facebook, for example, and thinking that maybe things aren't as bad as we think and that there is a sign that things could already start to stabilize, if not improve. You could arguably say that that was going on in the markets all day long. We got that data of a 4.8% drop in GDP earlier this morning. Markets were already shrugging it off, looking ahead to that news that we got from Gilead, I should see. I do want to notice here that tech, of course, is doing the best. It's up 3.6% today. And Russell, those small cap stocks, also some of the biggest outperformers as we continue to talk about how to reopen the economy. Gilead Sciences was the driver behind all of this as they were up more than 5.5%. They said that because of results of a U.S. government-run study, it showed that their experimental drug, remdesivir, helped coronavirus patients recover more quickly, some perhaps 11 days instead of 14 or 15 days that was initially expected. And so Dr. Fauci then came out again and said that this was a very, very positive sign. So perhaps all of this is looking past some of the negative data we got this morning and looking forward to future optimism.
Meantime, Taylor, Tesla and Microsoft shares skyrocketing, Facebook even higher. Let's start with Tesla and Microsoft. Tesla beating on revenue expectations, still saying they have the capacity to deliver 500,000 cars before the end of the year. And Microsoft obviously driven by a lot of this remote work that's happening from home. Wrap up the numbers for us.
Yeah, huge numbers out of both companies. Tesla beat on both revenue and adjusted earnings per share, getting a big boost on the bottom line despite a loss year over year. Free cash flow, though, Emily, if there's anything to caveat this, free cash flow is negative $900 million. That's worse than the expected drawdown in cash of about $600 million. The first quarter, they said, was impacted by deliveries. Remember, they had a goal of 500,000 deliveries in 2020. They are going to revisit that 2020 guidance in the second quarter, so we won't get details from them further on about the year until about June or July or so. Microsoft, similar story. Big numbers on the top line, 15% gain year over year. The cloud is better, and we saw this with Google and Alphabet yesterday. Cloud growth was a bright spot for the company. That is similar with Microsoft as well. They said cloud usage increased in a lot of their segments. And then, of course, personal computing. We're all staying home and working from home. That benefited as well.
Now, to a certain extent, we expected good news from Microsoft, to a lesser extent, Tesla. Facebook is really the surprise here. 2.6 billion monthly active user now, also beating on daily active users, and a significant increase in ad revenue despite that slowdown towards the end of the quarter. What's your take here?
My thoughts are we learned this from Google yesterday. They said that things were bad. The advertising market was weak, but it wasn't as weak as we thought. Estimates coming in from analysts yesterday as it related to Alphabet were much worse than expected. You're seeing a similar theme come here across with Facebook as well, where they said revenue was flat in the first 3 weeks of April year over year, but it wasn't negative, and they are already showing signs of stability within that advertising market within those first few weeks of April. And April really is supposed to be the worst. So if you're seeing revenue come in flat on a year over year basis in the worst of all of this, that is a big outperformer relative to expectations when we thought that ad revenue would decline significantly. So it's showing that these big advertising companies are proving to handle this better than we thought.
All right, Taylor, thanks so much for that update. We're going to continue to monitor these headlines as they roll in and the earnings calls begin. Taylor, thanks so much. I do want to bring in Deborah Aho-Williamson now of eMarketer, who covers Facebook. Deborah, I'd love to get your take on what Taylor mentioned earlier there, that we are seeing, according to Facebook, flat ad sales for the first 3 weeks of April, but the question is, could it get worse? And the real concern is about Q2, not Q1. What's your overall take?
Yeah, I think those are really excellent points. And I 100% agree. First of all, Q1 was a better quarter than most people expected. I do have to remember to say, though, that January and February were pretty much normal months. So we really only had March as being the month where there was a lot of concern and downturn. So for those who were saying that, Q1 was potentially going to be negative, I don't think we ever thought that in our particular models. But, you're right. Looking at Q2, there's a couple of things that really stood out for me. And I want to push back on the idea that the fact that Facebook has been flat for the early part of April is necessarily a good sign. If you compare that to what Snap reported last week, Snap actually also, which is very unusual for these companies, by the way, Snap gave an estimate that year-over-year revenue in the first couple of weeks of April actually grew 15% through April 19th, whereas Facebook said it was flat in the first 3 weeks. So if you compare those two companies' performance, then you have to wonder, well, what's going on here? It makes me think maybe Facebook's performance is actually worse than people think. And if there's stability in terms of flatness, that's not necessarily as good as having at least some revenue growth year over year in the beginning of the quarter. So that's something I'm going to want to pay attention to. I don't know if we're going to see something.
Yeah. The question then is, how bad does it get? And what's your sense? What's your sense of how bad this could get based on signs you're seeing in other places?
Yeah, and unfortunately, no one has a full crystal ball on that. I mean, I think one of the big issues is that businesses are reopening at vastly different rates around the world. So you have some countries where business is starting to reopen. There are other countries and even regions within those countries, like in the United States, where businesses are very much locked down. So any recovery that's going to happen at Facebook is going to be incredibly slow. It's got to be, with all of this, all these varying opening rates going on. I mean, you don't know what businesses are going to be open, to what extent, in which markets. There's a lot of change and challenge ahead, I believe, for Facebook. And that reflects itself in a lot of different types of businesses. I mean, we haven't talked about Facebook's exposure to small business. Small businesses are hurting horribly around the world. And Facebook has always touted the fact that they have 8 million advertisers, and that's obviously a very large percentage of those are small businesses. But I think a lot of that ad revenue could be in jeopardy because these businesses are trying to stay afloat, let alone actually spending more on marketing. So that's a concern that I think we still haven't seen fully play out, and we'll also be paying a lot of attention to that as well.
Okay, so small businesses, one big concern. What about Instagram? What about WhatsApp? What could the other pain points be?
Yeah, well, Instagram has always been a bright spot, I think, for Facebook, and I think it will continue to be. We think that advertisers are still very intrigued with Instagram, with stories, with shopping-related ads. That's definitely a place where I think advertisers are going to continue to play. Obviously, WhatsApp, the advertising potential within WhatsApp is pretty much non-existent because Facebook has pulled back on advertising within WhatsApp. And Messenger does have ads, although we don't hear a whole lot of traction on Messenger ads either. I think that, going forward, if we spin even further forward beyond Q2 and we think about some of the initiatives that Facebook is taking in terms of opening up video messaging and video chat, some of the announcements that they made last week for Messenger Rooms, we could see ad revenue potential in those areas, but that's definitely further down the road. So we're going to have to kind of weather through this difficult Q2 before we start to see any momentum on new or experimental areas of advertising like that.
These results also sent Twitter shares up. I'm curious, how do you think Facebook fares compared to Google, which, obviously we heard from Google yesterday. They're both getting the lion's share of the digital ad dollars, but does Google have an advantage given that, its bread and butter is search that Facebook doesn't?
I think that they're both in similar positions, and I think we saw that in the relative earnings reports between the two companies. I think that Google does have potential risk because it does have a lot of small businesses as well that are part of its advertising roster. But it did say in its earnings yesterday that a lot of the searches that were happening were not necessarily related to commodities, the things that kind of lend themselves to advertising. I'm assuming those searches were probably related to things having to do with COVID and staying at home, and those are less monetizable. In some cases, advertisers don't want to advertise on terms related to that. They've actually closed off those keywords. So I think if you were to compare Facebook and Google, they're both relatively in similar positions, even though their types of advertising market and the types of advertisers that they would typically reach out to may, in some cases, be different.
So, meantime, Mark Zuckerberg, we're getting headlines from earnings continuing. Zuckerberg saying COVID-19 will have a significant impact on the business. So that, Deborah, sort of alluding to what you said there, that there's so much that even Facebook, even Mark Zuckerberg himself, cannot foresee. And how dangerous is that?
Well, I think it's dangerous for every business. This has been said many, many times before. We're in unprecedented times. This is the uncertainty around the economy of markets around the world is weighing on every single business around the world. So I'm not surprised that Mark Zuckerberg doesn't know what's ahead. It's certainly something that a business like Facebook is going to have to confront, along with all of the other businesses that advertise on Facebook. That's really where it's going to come down to, is when these major advertisers, the auto companies, the entertainment companies, the travel firms that typically advertise on places like Facebook and on Google, when they are starting to be able to come back and open business. And there's so much uncertainty about the future for those businesses that I'm really not sure either exactly how they're going to weather this.
Well, if you did, we'd all be coming to you for the answer. Deborah Williamson, as always, thanks so much for sticking with us and giving us your thoughts. Meantime, we do have some breaking news. We're getting some comments from the president and also the governor of Florida saying they're planning to start reopening their economy on Monday, May 4th. The president saying he wants the country reopened and is concerned about being closed too long and that he would intervene if decisions made by the states were unsafe, but he wants to see sports stadiums packed again. We'll certainly be watching to see how other governors and other states respond to what the president's saying. Meantime, coming up, we're going to dig into Microsoft's earnings results, their first of the COVID era. How is all this remote work from home driving activity in the cloud? We'll take a look. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
During these uncertain times, we remain committed
to providing the news and data driving global markets.
To make sense of this situation impacting all of us right now.
And while we may look a bit different,
We stand by that commitment. We're here for you. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Continuing our look now at big tech earnings, Microsoft shares also skyrocketing after hours with all the new activity in the cloud and remote work happening from home. I want to bring in Glenn O'Donnell, an analyst with Forrester Research who covers Microsoft. Glenn, we expected Microsoft results to be good. Morgan Stanley naming Microsoft its top pick in uncertain times. Is there anything surprising about these numbers?
Not really. We expected them to do well, and it has been one of the companies that is still shining through all of this, and not surprisingly because it has been providing a lot of the technology that people need to get through this. All the work from home and teleconferencing and that kind of thing. Microsoft's products have been in high demand.
So where do you expect to see continued growth? And are you at all concerned that as the economy starts to reopen, we're hearing about it happening right now in Florida starting on May 1st, that some of the gains that Microsoft has made, whether it's in their Teams chat product or elsewhere, do those gains start to decline?
I think we will see some usage decline. However, much of what's happening now is going to continue as the new normal. As people start going back to the offices, not everybody goes back to the office. And I think we've all learned how useful these technologies like Microsoft Teams and Zoom and some others have been. And I have to say, I use all of these systems, and I've been personally very happy with Teams. The quality of the voice and video has been very good, and I think that's a testament to how Microsoft has not just designed its technology, but also handled the load. Most of these subscription services, you assume you're going to have X% of your customers using it at any point in time, and suddenly you have 10 or 20 or even 100X that factor, and you may run out of capacity. And that has happened with Microsoft. It's happened with everybody, but I think Microsoft has been weathering the storm well, and that bodes well in the long term because they're building trust with customers.
Meantime, we're getting headlines in now from the Microsoft call. Microsoft saying their Xbox Holiday 2020 launch is on track. Gaming is another huge part of Microsoft's business, and we know that gaming has generally seen a boost as a result of all of us being shut in. How much do you expect the gaming sector to buoy the overall business?
It's overall, it's still a fairly small percentage of Microsoft's revenue, so it's not going to make that big of a difference. And based on the release that they issued today, Xbox content and services were up 2%. I would have expected more, but coming back to subscribers, you pay for the usage, and you use it more. It's basically going to cost you roughly the same. So revenue-wise, it's not going to make a big difference when you have those bursts of activity. But again, the capacity is there, and gaming is a big business, but overall in Microsoft, it's still a fairly small percentage.
Meantime, Microsoft is also saying that the coronavirus and the pandemic is also hurting one-off licensing deals with small businesses. We know that small businesses have been particularly hurt by this crisis. The president is having an event with small business leaders at the White House right now. He's telling them the target date for reopening is as soon as possible, but that can, of course, and will, of course, vary from state to state. As we start to see these moves with these states reopening, what do you think the impact of this is more broadly on the markets and the companies that you cover?
Yeah, small business in particular has been suffering, and I do have concerns about the small business sector. Large business, most of it's okay. Travel and entertainment aside, the rest of the economy is still moving, albeit at a sluggish pace in some places, but the machinery is still trying to operate. So I think large companies are going to weather this. Small businesses is a different story, and the sooner we can get things restarted, the better small business is going to be. And the technologies from Microsoft are going to reflect that, as well as other technologies. If you go out of business, you're not going to be using your Microsoft Azure services anymore. But we'll have to watch that play out and see how small business performs and how things recover once we do start getting back in business here.
All right, Glenn O'Donnell of Forrester Research, thank you so much.
Thank you.
Glenn, we'll have to leave it there. Thank you so much for taking the time. Good to hear where you stand right now. Meantime, some headlines rolling in from the Facebook call. Facebook saying its profit margins will shrink this year due to COVID-19, but Facebook CEO Mark Zuckerberg saying Facebook plans to hire 10,000 more employees this year. That, of course, in contrast to Alphabet saying that they're slowing down hiring through the end of the year. So interesting to see that from Zuckerberg. We're going to continue to listen in to the call and bring you more headlines as we have them. Meantime, coming up, Google wants in on the Zoom action, making its Zoom competitor free. We'll talk to our own Mark Bergen about that coming up. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Welcome back to Bloomberg Technology. I'm Emily Chang. Google Meet is now going to be free for all users. Google wanting in on the Zoom action. I want to bring in our Mark Bergen, who covers Alphabet and Google for us. So, wow, this is a huge move. Obviously, Google Meet has been a video conferencing competitor and option to Zoom. However, Zoom has really gotten a lot of the mind share. What does this actually mean, Mark?
Yeah, I mean, it means Google has a chance to sort of catch up, right? This is, one way to look at it is Google had Hangouts chat for years, right? They have Gmail, they had this built-in, they have the bandwidth technology and the money. This sort of video chat was theirs to lose, and they lost it in many ways to Zoom. And then we saw Verizon Wireless getting in, Microsoft with Teams getting much more aggressive, and now last week Facebook announcing that it's coming out with its own free video chat service. So I think this is sort of Google's only way to get a foot in here, it's a strong foothold. They are requiring people sign up with a Google account to use this, and clearly right now they said they have 100 million users of Meet. I'm sure that number is going to skyrocket once it becomes free.
And Zoom does have, a free option, but what does this mean for Zoom, for Microsoft, for WebEx, for the other players in this game?
Yeah, so Google's right now saying that they are capping they have a 60-minute limit for this, but they're not enforcing that till September. It'd be interesting to see if this becomes something where it's a lot of people just using it to catch up with friends, or if it's something that a lot of businesses start to use the free version, right? I think Google's logic here is that that they use a free version, they're most likely going to start signing up for the paid G Suite account, and that's where Google's really trying to challenge Microsoft. Zoom stock was down about 11% today. There's some argument whether that stock's been inflated for a while, given their revenue, but it's clearly a challenge for them.
Right. And of course, Google has deep pockets, so can do something like this. Okay. Bloomberg's Mark Bergen. As always, Mark, thank you so much for your insights there. Coming up, we're going to take you back to earnings results and dig into Tesla with its first quarter earnings report as production remains halted at its headquarters here in California. We'll be speaking to Tasha Keeney of ARK Invest coming up. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
in San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day
sizable moves in the currency market. Averages down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the first word Asia.
The U.S. and Japan duke it out over exchange.
China's slumping onshore bond market is great.
Welcome to Bloomberg Technology. I'm Emily Chang in San Francisco. To Tesla earnings now, profitability better than feared. Tesla saying it's still on track, still can deliver 500,000 vehicles by the end of the year, but production remains a huge concern. Production at its headquarters in Fremont, California has been ground to a halt. I want to bring in Tasha Keeney of ARK Invest, and Tesla is the firm's top holding in many of your funds. Tasha, what's your take on the headline results here?
Yeah, so I think, a lot of focus is going to be on sort of these short-term, when is the factory going to reopen, exactly what is the next quarter sort of going to look like. But I think in terms of the long-term picture, which is what we're interested in at ARK, we're long-term investors, the long-term impacts of COVID-19, we think, are going to be that the auto industry, which was already going to consolidate because of autonomous electric vehicles, not every automaker was going to successfully survive that transition. That's just going to be pulled forward. So you're going to have companies that are going to be struggling. They're going to look to the core business. They're going to start cutting innovation projects. We just saw Ford cut their effort with Rivian for electric vehicles. And companies like Tesla that are already further ahead on autonomous electric technology are really going to shine here. I think for the short term, the China factory is really key for Tesla. That's already back up and running since the shutdown earlier this year. So we're looking forward to sort of see what happens.
But what about demand? I mean, it's certainly one thing if they can't make the cars, but let's say production restarts. Is demand really going to be there when you've got 22 million people out of work, unemployment at 20%, and economy that has been plunged into a recession?
Yeah, I think for the auto industry as a whole, we could see auto sales actually hit their peaks. We think that longer term, two-car households are going to become one-car households as we undergo this shift towards autonomous technology. But for something like electric vehicles, and particularly in Tesla's case, they've always been supply constrained. So we really see sort of that demand still there. And in the next couple of years, an electric vehicle on a like-for-like basis, according to our work, is going to be cheaper than a gas-powered car. So that sticker price is really what's going to drive that uptick in demand. So it's already lower on a total cost of ownership basis and on an operating cost basis. Now it's going to become cheaper on a sticker price basis.
I want to ask you also about regulatory credits, because there were $354 million in revenue attributable to regulatory credit. And I wonder if without those, the situation would look very different and significantly worse. I mean, what are your thoughts on that?
Well, I think the key number to look at in the report is automotive gross margin excluding credits, which came in at 20% for the quarter. That's higher than most analysts were expecting. They were seeing something they thought there would be something in the teens. I was seeing between 16 and 17% for estimates. So that number be excluding those credits, but zooming back out, when we model disruptive technology at ARK, we don't take into account any regulatory action. It's hard to predict, and we want technologies that are viable in the underlying economics without any of those subsidies. So that's how we model electric vehicles and the battery cost declines associated with them. So even without any of the support from these credits, we think EVs will take off just on those economics.
So It's certainly one thing if the car industry in general is slowing down and slowing down, especially after this. And I understand that Tesla might be a winner relative to other car makers, but it can't be good for Tesla if people in general are going to own less cars. People in general are going to be financially strapped. And I wonder how that fits into your long-term optimism here.
Yeah, I think so. Here's what I'll say. The long-term picture, I do think people are going to own less cars, and it's because they're going to start using autonomous ride-hailing networks. And one interesting opportunity that I think is really overlooked for Tesla is they plan on launching an autonomous taxi service once they achieve full autonomy. But even before that, Elon Musk has said that they would launch a ride-hailing service with human drivers. Assume that they did that coming out of the crisis. There's going to be a pent-up demand for gig workers. Uber and Lyft are hurting right now. Tesla is already cheaper on an operating cost basis than a traditional car. That could mean better driver pay, a better take rate for Tesla. They could collect more miles for autopilot, and they have a vertically integrated financing and insurance offering. So we actually think that business in particular could have very good profit characteristics for Tesla. So really, Tesla's transforming into the services model longer term. So I think that's what we really want to focus on. But, again, big picture in the automotive world, everything is shifting towards electric vehicles. And Tesla is the leader in electric vehicles. We think they're 3 years ahead of the competition. So even on the core business, that's sort of the view that we look at.
Another point that you've made in some of your research is that you think that Tesla's plans to start a ride-hailing business, that they should do that sooner rather than later as we come out of this crisis. I find that interesting, especially given that Uber and Lyft are really struggling. Lyft just announced a round of layoffs. Uber is considering reportedly a big round of layoffs. Why do you think Tesla should invest in that right now?
Yeah, so, as I mentioned, Tesla has this innate cost advantage over anyone operating a different car, because electric vehicles on an operating cost basis, we already know are cheaper. Maintenance is cheaper. Total cost of ownership is cheaper. So that's sort of, a better characteristic for drivers to sign up. And then the financing and insurance, because Tesla is able to offer that, and that's vertically integrated into the company itself. We think they could have a better cost profile and profit profile on that business as well, compared to Uber and Lyft that have to look to outside partners. The reason to do it coming out of the crisis is because, so right now, ride-hailing is hurting, and that makes sense. But if you think about when the stay-at-home bans are lifted, would you want to get into mass transportation, or are you going to want to get into maybe a ride-hailing vehicle or a personal vehicle? We actually heard today on the NXP call that we're already seeing people buy their first car ever because they want to avoid mass transit. So I think that ride-hailing could actually be strong coming out of this. So that's sort of another reason for Tesla to really strike while the iron's hot. And again, sort of those underlying cost dynamics already set up a really nice profile for Tesla. It aligns with its long-term vision to become an autonomous taxi provider. So I think the time is really now to do that.
Interesting. All right. Well, that's something we'll certainly continue to follow. Tasha Keeney of ARK Invest. Always good to have you with us, Tasha. Thanks so much.
Thanks for having me.
All right, coming up, we're going to dig into those Uber and Lyft layoffs. As I just mentioned, Lyft announcing today it's planning to lay off a huge chunk of workers. Uber also considering some layoffs. We'll have that story after this quick break.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Taking a quick look at Facebook shares after hours skyrocketing. Mark Zuckerberg saying Facebook plans to hire as many as 10,000 people this year, 10,000 additional employees. This as Google has announced a hiring slowdown. Facebook saying ad sales were significantly down from travel and autos in particular, particularly relevant to the conversation that we were just having. They see strong ad growth, however, coming from the gaming industry, and they're starting to see the first signs of stability for the ad business in the first 3 weeks of April, with ad sales during the first 3 weeks of April being flat. Facebook will, however, be looking to cut travel, marketing, and construction costs. We're continuing to listen in to the Facebook earnings call, and we'll bring you more headlines as we have them. Meantime, I do want to talk about ride sharing. Lyft announced today it is letting go of 17% of its workforce, furloughing more employees. Uber also reportedly considering some big layoffs as well. I want to bring in Bloomberg's Lizette Chapman, who covers ride sharing for us. Lizette, let's start with Lyft, since this is what we know for sure. Walk us through the cuts and what this means.
Right. So Lyft announced today that they would be slicing 1,000 of their employees, or about 17% company-wide. This would take effect immediately. And they also announced a 5% furlough of employees, along with pay cuts company-wide, ranging from 10% up to 30% for the executives. They also announced that they were going to suspend scooter operations. And this was a series of cuts that they said they had to make.
What do we know about Uber's plans? We know that the chief technology officer is stepping down. He's been there a long time, but also reports that Uber is considering laying off 20% of its workforce. Do we know more?
Correct. There have been reports that they are considering that. The company has not yet formally commented. The longtime CTO did, resign recently, and gave his notice. And this follows Maneet Gupta, who was the CPO, who resigned a couple weeks ago, as well as Jason Dragill, longtime employee. So they're also facing a bit of a leadership kind of suck, if you will.
A leadership vacuum for sure. I mean, talk to us about the soundness of Uber and Lyft. By the way, those reports coming from the information that Uber is considering laying off 20% of its workforce. Talk to us about Uber versus Lyft at this time. Obviously, Uber is a much larger company, which can be good or bad. Uber does also have Uber Eats. Lyft, however, is more focused almost entirely on the United States, though it has been making small steps to expand internationally. Is one more in trouble than the other?
That's a great point, is that Lyft is focused on North America. Uber is focused globally. Lyft has been completely focused on rideshare and recently spinning up some of its delivery options through partnerships. Uber, on the other hand, has all of these other businesses. They've got Uber Eats, like you mentioned, and they have seen an uptick in that, and that's something that we will be probably watching for when they report earnings next week.
All right, Lizette Chapman, who covers ride sharing for us, thanks so much. I should mention that the scooter company Lime also announcing some layoffs today, 190 people. We're going to continue to cover all of these stories as they continue to evolve. Lizette, thank you so much for that update. Meantime, I want to bring you another story. The Trump administration planning to launch Operation Warp Speed, a Manhattan Project-style initiative to drastically cut the time it takes, and it will take, to develop a COVID-19 vaccine. Meantime, Lauren Sauer, an assistant professor of emergency medicine at Johns Hopkins University, says the country still has a long way to go with testing capacity. Take a listen to a conversation with our own Tom Keene from earlier today.
People are probably tired of me harping on testing, but I think it's absolutely the underpinning of everything else that we need to do. So while we're getting better with testing, we still have a long way to go, and we really need to keep laser focus on that. On the medications, we're seeing a lot of progress. We're seeing vaccine progress, which is great to hear because that is going to be a key to long-term fighting of this disease. But again, a lot of ways to go.
What do you find the most reassuring and the most concerning about testing? How much more testing do we need in the U.S., and are the tests reliable right now?
The point-of-care diagnostics are getting better, and they're getting picked up more broadly. We still have major issues with the supply chain around testing, so we still need the reagents, the materials that we need to run the test. We still have issues with the swabs that you use to take a lot of these tests. Still have to focus on making sure that we don't just have enough tests, but they're in the right place, because the key to reopening and the key to getting back to work is making sure that the tests are distributed in a way that we can detect where clusters may pop up and where new outbreaks may occur.
Lauren, let's go to your core competencies, which is emergency medicine. Okay, so we're going to have emergency rooms in May, in August, in October across this nation, where people are going to walk in the door because, afterthought stubbed her toe or somebody broke an arm, et cetera, et cetera. We're going to test all those people for the virus, aren't we?
That's the hope, so that we can move them into the hospital and get them the care they need without putting them at risk, putting our other healthcare workers at risk, and putting our other patients at risk. So the idea would be as people who don't show symptoms of COVID-19 come into the hospital, we would put them in a different part of the hospital and still be able to safely care for them while we're caring for COVID-19 and while we're still dealing with having COVID-19 out in the community.
Well, I look, Lauren, at this and, the huge challenges. I'm right here by Mount Sinai on the Upper East Side in New York, and you can just see it in the faces of the people. Are we going to end up with 2 emergency rooms, 2 hospitals?
I hope that we aren't. I think we can't distribute our clinicians like that. We can't distribute our resources like that. I think we hope that this will become a disease that we can manage with tools like we have for other diseases that make people really sick, like flu, like HIV, like a bunch of different diseases, where we can find people who have it early, safely care for them without putting others at risk, and that our supply chain and our resources allow for that.
I look at all that's going on in the virus, and of course the sadness here of 58,000 deaths as well. And we make an historical note, the same amount as we exceed those killed in Vietnam as well. Give us a scope and scale at the Johns Hopkins University right now. Can we say that you look forward to a May that will be improved from April?
I do hope so. I think we're seeing a slowdown in our cases, and we're starting to feel that pressure release a little bit, but that's the time to be vigilant and not let our guard down, because we will see spikes in cases, especially as people relax their social distancing practices, as they try to go back to work, as they, just get tired of being at home and make different choices. So we have to remember that just because we're seeing that slowdown in cases doesn't mean this is over, and doesn't mean that we suddenly have a toolkit full of tools to fight this. So we have to be protective. We have to follow those social distancing still, and it does get hard. And I think we have to remind each other that it's still really important.
All right, coming up, we're going to be talking about Amazon. Amazon also reporting earnings later this week. We'll get a preview from our own Matt Day. Coming up, this is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Melinda Gates, thank you so much for joining us on Bloomberg Studio 1.0.
Who shaped my views were the women I talked to.
I think Facebook's probably won in a lot of ways.
Running Microsoft was a ton of fun, and it was, it's kind of inspirational.
This is your weekly review of the most important business news and interviews from Bloomberg Television around the world.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Good evening, I'm Sherrian in New York with Heidi Strout-Watts in Sydney. We're counting down to the market opens in Australia and Japan. Welcome to Daybreak Asia. Our top stories this hour: Asian stocks set to rise after Wall Street rallied to a 7-week high. Strong tech results put the Nasdaq on track to raise 2020 losses. President Trump sees light at the end of the virus tunnel. Project Operation Warp Speed aims to drastically cut the time it takes to develop a vaccine. Fed Chair Jerome Powell talks of heartbreaking harm from the coronavirus and says the pandemic has brought the U.S. to an abrupt halt.
Well, Sherry, we are seeing optimism with the Asian stocks really primed to follow the leader when it comes to gains that we saw on Wall Street overnight. The S&P 500 gaining 2.5%, touching a 7-week high at one point. This as we had the dual optimism over perhaps a faster than expected track to a vaccine with the so-called Operation Warp Speed from the Trump administration. Also more encouraging news about efficacy on a Gilead Sciences therapeutic as well. We're taking a look at gains now resuming in New Zealand. We're seeing Japanese futures pointed up after yesterday's public holiday. US futures also showing an extension of those gains. Aussie futures looking pretty positive as well. We do have Korea closed today and Hong Kong markets closed for that Buddha's birthday holiday. But taking a quick look at oil, because we're seeing a second day of gains for WTI after that 22% plus gain in the overnight session. We're seeing opening up here higher by over 6% in Asia. This sort of sense of a recovery while producers curb output, and we are seeing demand perhaps starting to see a recovery as well as we get closer to an economic reopening, Sherry, in some parts of the world.
Yeah, so let's discuss Operation Warp Speed, because the Trump administration's plan hopes to drastically cut the time it takes to develop a coronavirus vaccine, and that comes as a drug from Gilead is showing promising results in clinical trials. Our Bloomberg opinion columnist Max Neeson joins us now on the phone. Max, great to have you with us. So despite what you might call it, this fancy operation, is it historically feasible to really be able to develop a vaccine by year's end?
Going based on what we know historically, it would be unlikely that we get a vaccine even by the end of 2021. Vaccine timelines are traditionally long, and they're long for a reason. It's not something that you can really skimp on the safety testing, because ideally it's something you give to a whole population. There are things you can do to speed that up, and companies, working very hard to make that happen, and then the Trump administration stepping in with certain efforts that might aid it. But, at the end of the day, the only thing that can truly, make get a vaccine to market speedily is the vaccine actually working, being effective and safe. And that's up to, human biology and the efforts of these drug companies, not something that the Trump administration can really directly ensure works. So that timeline is always going to be a little risky.
Max, are you cautiously optimistic on the therapeutic side? Anthony Fauci seemed to think that, this early data that we saw in the Gilead Sciences treatment was encouraging.
I'm more optimistic than I was yesterday that we have at least one tool that might be useful for certain patients. In this case, people that are hospitalized and have a chance of getting much worse. What this isn't is, that silver bullet treatment we're all hoping for that is, have this widespread utility and then can broadly sort of bend the curve of outcomes for the virus. This is something that has has shown convincingly in a relatively large study, although we still need more data on it, that it has an impact in a certain group of patients, a fairly moderate one, though, and it's a drug that has to be infused over time, usually in a hospital, and is difficult to make. So in terms of, the being able to genuinely change the trajectory of outbreaks or encourage people to return to economic activity, I'm not sure that this medicine is going to be that answer. But over time, we'll get more data on other drugs. We'll get, in addition to the work on vaccines, there's ongoing work on monoclonal antibodies targeted directly at the virus, which have a chance of being more effective. So we'll just see what happens going forward. But this is at least of some utility, likely, given the data that we have so far.
And Max, when it comes to reopening the economy, many are counting on potential antibody testing to help make that decision. How much research have you seen out there on whether or not this coronavirus antibody actually means immunity?
So that's something that we're only in the earliest stages of understanding, unfortunately. In order to genuinely establish that an antibody test confers, or at least testing positive on an antibody test means that you're immune for some time to come, we're going to have to give a lot of people those tests and follow them for months, just because what we know is pretty limited. We're kind of drawing limited comparisons based on other coronaviruses that previously circulated and on limited animal data. We really don't know that much. It could be that it lasts for years. It could be that it varies by depth of infection. It could be that it peters out within a year, like you see with the common coronaviruses that cause many mild respiratory illnesses. We really just don't know, and it's going to take further study.
All right, Max Neeson from Bloomberg Opinion there with us. Well, still ahead. Tesla surged in late trade after beating estimates, but will it face speed bumps ahead? We'll get some more analysis later on in the show. But coming up next, we'll be joined by Columbia University's Patricia Mosser. She spent 2 decades at the New York Fed overseeing monetary policy implementation, including crisis-related facilities. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
watching Daybreak Asia. I'm Karina Mitchell with the First Word headlines. Germany sees the pandemic pushing the economy to its worst recession since World War II as business and household confidence collapses across Europe. GDP is forecast to fall by more than 6% this year, more than in the financial crisis, with the low point expected sometime in the second quarter. The government hopes its trillion-dollar rescue package will help limit the damage. Japan's 47 prefectures are set to ask the government to extend the state of emergency as coronavirus numbers continue to rise there. Tokyo's Yuriko Koike said the situation remains severe. Unemployment claims are surging in Southeast Asia, with almost 9 million people registering for aid in Indonesia. And the labor market is slumping as well in Singapore amid its sharpest contraction since SARS in 2003. In the U.S., Fed Chair Jay Powell says the coronavirus has brought the economy to, quote, an abrupt halt as he held interest rates near zero and pledged to keep them there until the U.S. is back on track. Powell talked of the heartbreaking harm the pandemic has caused and said activity will likely fall at an unprecedented rate in the coming months. He said there may be a need for more Fed action to support the recovery. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Sherry.
Right, staying with the Fed, how much more can the central bank do with rates near zero and unprecedented credit facilities in place? Patricia Mosser is head of Columbia University's MPA program in Economic Policy Management. She served for 2 decades at the New York Federal Reserve, overseeing markets and monetary policy implementation, including crisis-related facilities. Patricia, great to have you with us. Thank you very much for your time. I guess the first question would be, does the Fed even need to do more at this point? We know that its bulk of lending facilities are not even operational. So once they all become operational, will that just be enough to support the economy, or do you foresee more things that the Fed will need to do?
So thank you very much for having me. It's my pleasure to be with you. I think they probably will have to do more. Chair Powell described it as a sort of stop. I describe the economy as stepping off a cliff, and we don't know how far that cliff is down. And I certainly agree with Chair Powell that both fiscal and monetary stimulus more may be needed. Maybe stimulus is the wrong word. Perhaps a better description is disaster relief, because that's a little bit what we're living through right now.
When it comes to supporting these different sectors of the economy, we have seen the Fed really getting into the municipal market, not to mention high yield credit, corporate credit markets as well. There's been criticism that the Fed has moved out of its policy lane. What's your assessment?
So it is extraordinary. I agree completely. It's atypical, very atypical for a central bank to be doing this. But it is extremely clear that in this kind of extraordinary circumstance, this sort of coordination between the fiscal authority and the central bank is the smart sort of policy coordination. I also think it's very clear the mandate from Congress that they effectively gave the Treasury Department $450 billion to backstop particularly risky lending that the Fed could do is a direct acknowledgement of that. And it makes a lot of sense, although certainly central banks, either in the credit market or in the municipal market, deciding who's going to get credit on what terms is a very unnatural position for them to be in.
Patricia, we were speaking to Alan Blinder in the last hour and just talking about how blunt or unsuited the Fed's tools, or really any central bank's tools, are to deal with the crisis that's playing out more painfully on Main Street than on Wall Street, right? So in that way, I guess, what more can they do? They're clearly trying to figure out a way of transmission to get the money to the parts of the economy, to the parts of America that are hurting the most.
Absolutely. And the degree of complexity is obvious in the fact that the delay in the credit programs, particularly the Main Street lending facility, to a lesser degree the municipal facility, is a reflection of that complexity. And I thought in the press conference it was very interesting today that Chair Powell basically said that the Main Street facilities are probably going to be later than, for example, the corporate bond facilities. And moreover, that they might very well roll them out in stages. And I think that's an acknowledgement of the complexity. But we've already seen a taste of the complexity just in the PPP program. It's very difficult to figure out what demand is, what the right terms are. And that's not a monetary policy. That's not a Federal Reserve program. That's purely a fiscal program. That said, some way to figure out how to provide bridge financing to businesses, to households, to keep incomes at least stable enough for long enough to ride through the very sharp decline we're going through now, is an incredibly important goal for both the fiscal policymakers and for the Fed. I did find one last comment. I did find it interesting that Chair Powell alluded to fiscal policy a lot more than a typical Fed chair does during a monetary policy press conference, but explicitly saying that there are certain things that a central bank is just not going to be able to do well. They can't do grants. They can't specifically give transfer payments. They can't do those things. And so the role on the fiscal side here is big, frankly, bigger, in my personal opinion, and can be much more targeted in a way that a central bank and certainly monetary policy tools can ever be.
Right. So, as we talked about, Fed Chair Powell spoke about this idea, this is not the time to worry about overspending. And that's a sentiment that we'll hear from governments. We're doing whatever it takes. And even then, it may not be enough. So you see these programs being scaled up and up and up again. At what point do we need to worry about the structural issues that this is creating for the U.S. economy and the balance sheet?
So I agree completely that as far as the United States is concerned, that the last thing you want to worry about right now is the size of the deficit. Because if the economy recovers, if you come out of this with strong growth and employment and jobs and businesses that are healthy, that tax revenue and the grants will go away, the extra tax revenue will come back, and then you sit down and you figure out how to make the fiscal situation in the United States sustainable over a longer period of time. You don't worry about that right now. There are many other countries in the world that really do have to worry about this to a much greater degree than the United States does, but I agree completely that right now that's not your first order of business. Structurally, I think the question is how much of this does one want on the central bank balance sheet versus how much is going to be on the fiscal side of the ledger. Again, given that inflation has not been a problem in the United States, or frankly in very few places in the world has it been, I'm not particularly worried about that part of the equation either in the short run. But the short run here is also defined as not, this doesn't go on for 5 years, but it goes on for a fixed amount of time until the economy can bridge to the other side of this. The problem with not doing that, and here's the alternative. The problem with not doing that is that you end up with a much weaker economy in much worse shape, and then the fiscal situation, not to mention the monetary policy situation, is just as bad, if not worse, than it would have been if you were aggressive up front. So there is definitely more now, hopefully with a better outcome, and then you have to do less later.
And Patricia, just finally, we have seen the Fed now lending directly to big companies, but they haven't really put any restrictions when it comes to dividend or CEO pay rules. We have seen from the fiscal side of things as well that they have started helping out those small businesses, but because of some loopholes, big corporations have also been able to tap into those funds. Should there be more restrictions on how all of these funds are being disbursed, whether it's coming from the Fed or from the U.S. government?
So putting on restrictions on what borrowers do, covenants as they're called in the private, and if these were private lending relationships, is very common for small firms and less common for large firms. And right now that is approximately, not the PPP program, let me put that aside for the moment since that's a fiscal policy program, and frankly, that is essentially a grants program and not a lending program. But the Federal Reserve's programs are definitely going to be lending programs. They're expected to pay back the loans. And so a set of restrictions on behavior for smaller companies are common, not for larger companies. I think the question it will come down to, is that the right equitable distribution given the other restrictions that are in the CARES Act, even for aid, and this is fiscal aid, to larger firms. I don't know how that's going to play out, but one could certainly make the fairness argument. Although right now, the way the term sheets for the programs are written, there is absolutely a difference. I think it's clearly up to the Fed and perhaps Congress, if they want to change the rules of the game with respect to legislation, to figure out how they want to structure that.
Patricia, thank you so much for joining us. Patricia Massa, Director of the MPA Program in Economic Policy Management at Columbia University. All right, we do have these lines crossing the Bloomberg when it comes to what lies ahead for the UK's reopening plan, and we are hearing from the Prime Minister, the UK PM is reportedly to tell the nation not to expect any changes to the lockdown. That's according to the Telegraph newspaper. It's interesting because we have kind of heard this kind of sentiment before. Boris Johnson is expected to warn the nation, manage these expectations, if you will, not to expect major changes to the lockdown after it emerged that Britain has had one of the world's worst death rates when it comes to the coronavirus. The PM is reportedly going to use his first Downing Street press conference since his return to work, since recovering himself from COVID-19, to explain why these social restrictions must largely remain in place. So we'll be expecting that address from Boris Johnson a little bit later. Well, lots more to come on Daybreak Asia. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
All right, we'll be watching ANZ shares at the open in Sydney trading after the lender reported a 60% plunge in first half profit. Let's get more from our Bloomberg Finance and Investing reporter Emily Cadman here in Sydney. And this horror season for Aussie lenders continues.
Yes, I mean, it's certainly a bit of a change from a couple of years ago where, we were talking about these great money-making machines. I mean, I think like lenders in the rest of the world, banks in Australia are really at the forefront of the, initial wave of the coronavirus economic impact. The driver behind this, another poor result, is a huge rise of impairments. These are generally what the bank is kind of, at this stage, they're not looking at individual loans so much and saying these have gone bad because of Corona. They're looking at the expectations of a much, much worse economic environment and doing a broad economic overlay of the damage they think this virus is going to cause to their loan books, and it's not pretty.
Emily, the bank also deciding to defer the dividend. How does that reflect their financial position?
Well, they've been very clear to say that it's not a reflection of their capital position. That's one thing they're pushing there. What they are saying is that there's just such a huge economic unknown at the moment that they just don't think it's prudent to pay money out to shareholders at this time. And that's something that will be welcomed by the authorities, who, whilst they haven't actually banned dividend disbursement, have asked lenders to be very, very cautious on what's going forward. After all, until we know just how bad it is, you don't want money going out to shareholders and then leaving the bank in a difficult position down the line. So what ANZ make clear, though, is right now the decision is deferred. It's not a cancellation. They're going to review the situation and give an update to the market in August.
Emily, when it comes to credit losses and the NPL situation, when are we going to have a better idea of how it's impacting the Australian banks?
So when we spoke to National Australia Bank CEO Ross McEwen a couple of days now, Heidi, I think what he made clear is the picture's really going to become clear once the payment holidays that the banks have granted. As a quick recap, the Australian banks are allowing both business and mortgage holders to essentially take a 6-month payment holiday whilst they sort themselves out. It's after those payment holidays come to an end that we'll start to get a real picture of who can't afford their loans in the new world. So we're talking probably 5 to 6 months, I think, before we really start to get more of a picture on this.
Emily Catman, finance and investing reporter, thank you very much for that. Let's now get a quick check of the latest business flash headlines. Standard Chartered has set aside almost $1 billion for potential bad loan losses because of the coronavirus, even as a trading boom lifted first quarter revenue. Standard Chartered reported the biggest provisions for 5 years as clients across Asia, Africa, and the Middle East saw trouble. First quarter earnings slid 12% to $1.2 billion, while operating income rose 13%. Sinopec swung to a loss in the first quarter as a collapse in oil demand hit refining and prices collapsed. Asia's biggest refiner reported a net loss of $2.7 billion compared to a profit of just over $2 billion the year before. Asian refiners were the first to shut facilities in early February because of the coronavirus, as demand for everything from aviation fuel to gasoline took a massive hit. Samsonite says it expects March sales to fall by up to 55%, contributing to an overall sales decline of 26% for the first quarter. In a stock exchange filing, it said first quarter earnings before tax are expected to be slightly positive, but significantly lower. That, of course, follows lockdowns and travel restrictions around the world because of the coronavirus. Up next, we'll talk to Sandhill Strategy co-founder Katie Bates about her outlook for the energy sector. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
During these uncertain times, we remain committed
to providing the news and data driving global markets.
To make sense of this situation impacting all of us right now.
And while we may look a bit different,
we stand by that commitment.
We're here for you. This is Bloomberg.
You're watching Daybreak Asia. Let's get a quick check of how markets are trading at the moment. We are seeing U.S. futures gaining ground with Wall Street seeing stocks jumping to a 7-week high. We had muted market reaction to the Fed decision, broadly in line with estimates, but more optimism about a potential drug against coronavirus. We do have Japan futures also gaining ground at the moment, rising 1%. We have seen strength in the Japanese yen, which has gained for the past 6 sessions. We do get March industrial production and retail sales numbers in just a few moments, so do watch out for that. When it comes to Kiwi stocks gaining ground for a 6th consecutive session, this is the best performing market across Asia since the sell-off that we saw last month. We are also seeing surprising strength for the Kiwi dollar. In fact, surprising strength for the Kiwi dollar, Aussie dollar against the US dollar. Those currencies linked to China, which is already now easing lockdown measures, and we're seeing a little bit of recovery and stability when it comes to their economy. WTI continues to add to those gains that we saw in the New York session, above $15 a barrel. Heidi.
All right, let's stick with oil, I should say. Joining us out of Washington is Sandhill Strategy co-founder Katie Bays. Katie, always great to have you, and thank you for joining us. We're seeing this really strong rebound. Has anything meaningfully changed? I mean, we know that producers are scrambling to curb out. Well, is there a sense that the global glut is maybe starting to bottom out?
Yes, and thank you all so much for having me. It's great to be here. It is a little hard to imagine that we're celebrating over $15 crude oil, but yes, it does feel good to see crude in the green for the last couple of sessions. So very relieved for that. I think the big drivers, kind of like you were just saying, there's optimism about some therapies for coronavirus, so maybe a more rapid return to work than folks might have been anticipating. That's certainly good for energy markets. And then also, to your point, it's the belief that we're starting to see real supply reductions, especially out of the United States. That was the big X factor. And we're starting to see durable evidence that as much as 1 million barrels a day might be coming offline in the near future. Near future is maybe the next couple of months, but that's still a very positive sign.
We're starting to see refinery processing see something of a recovery as well, right? How much of this is going to be down to whether we see this resumption to normal, resumption to traffic and fuel consumption and demand be sustained and scaled up out of China?
Yeah, absolutely. And I will say, I've seen estimates that show refinery run rates maybe currently in the 50% kind of ballpark territory, depending upon where you're looking, returning to 70% run rates, maybe in normal run rates by the fall. And those estimates are extremely bullish, but very constructive for crude oil demand, of course. And all of that comes back to this issue of when are folks more or less going to get back to normal. China's a very strong indicator. And of course, we've had the Chinese majors reporting in the last day or so, and they've really, given a tentative forecast for Q2 here, but looking at a more optimistic Q3 and Q4. And, refinery runs are turning into a little bit of a bright spot because obviously with crude prices so low, that's a great opportunity for the refiners.
Of course, we have seen capex cuts announced by these Chinese majors, but they really haven't compared to their global peers, have they?
No, they haven't. That's a good point. It's kind of remarkable, and I think it's very interesting. We've seen U.S. producers really signal that we're going to cut capex, and we should read through from that capex cut to a big cut in production. But for the Chinese majors, we're seeing more like a 2 to 5% cut in capex. Definitely, as a state-owned enterprise, more complicated to really cut capex. But I think it's also a signal that China is doing something that honestly we saw the U.S. do in the 80s after the energy crisis in the late 70s, which is to really turn inward and look inward at domestic production and look at your own sources of supply rather than being dependent upon what could be a really fragile global supply system. I think that's a big lesson we've learned in the last 9 weeks. It's a really important lesson, and one that I think we should all be cautious about. When it comes to China and our long-term modeling, is China going to be the big importer that we see it today, 3, 4, 5 years from now?
Yeah, so does that mean that China could be adding to the glut in just a few years?
Exactly. Yeah, I mean, we see China importing, 9-10 million barrels a day in the sort of present environment. That's a, enormous amount of crude on a 100 million barrel a day market. And so if we see the Chinese majors in a couple of years or 6 months to, a year starting to increase capex again as the world stabilizes and focus on trying to bring down, Chinese break-evens are $40 to $60 a barrel, not as competitive maybe with the West Texas producers, but China has shale, China has a desire to develop that shale, and so if we really see offshore resources and shale resources getting new major investment, that's a signal, I think, that China is really focusing on upping domestic production. I think we should all be looking at the 14th five-year plan, which is China's sort of economy-wide outlook coming out, we think, later this year. That is a big signal of where future Chinese investment is going to be focused for the majors.
Does this really, when you look at the demise of US shale, does this really change the landscape geopolitically when it comes to oil dominance in the world?
Yeah, so I think one of the most important lessons for folks in the investment community and folks in the policy community as well, where we kind of spend a lot of our time, take away from this period of time is that, today's shale crash and today's oil price crash is not the same price crash that we had in 2016. This is a really unique set of circumstances. Capital markets in the U.S. have become fatigued with crude oil. You do not see crude trading at $16 because this is a promising area for future investment. Investors are genuinely cautious about making future new investments in shale. So what does that mean? It means that this is ultimately likely an opportunity for the majors more than the independent producers. This is an opportunity to go out and pick up acreage more cheaply and pick up reserves more cheaply because if capital is not available to some of our wildcat drillers here in the U.S., there's really not much runway available for them, right? A lot of these guys don't produce much cash. So that's the hard reality of where we are today. This process, and I think this all started really with the, what was the war on U.S. shale coming out of OPEC and OPEC Plus. But that war is, I think, ultimately going to be won to the extent that it's won against shale. It will be won in the capital markets with a lack of capital availability. So those are the things we really worry about for our companies and for our clients.
Sandhill Strategy co-founder Katie Bates, thank you very much with the latest on oil. And we have an alert on the Bloomberg right now. We have Media Group first quarter earnings coming in. The group reporting first quarter revenue at 58 billion yuan. The first quarter net income at 4.81 billion yuan. When it comes to net income, that 4.81 billion yuan would be a fall of 22% year on year. When it comes to first quarter EPS, 69 renminbi cents. Revenue, again, when it comes to the first quarter, 58 billion yuan would be a fall of 23% year on year. Media, the world's largest appliance maker. Let's now get the first world news with Karina Mitchell. Karina.
Sherry, President Trump says he sees light at the end of the tunnel in the fight against the coronavirus, with the fourth quarter of the year to be, quote, really, really good. Meeting U.S. business leaders, he said the coming months will be a transition period, echoing predictions from his economic advisors. The White House has been urging states to consider reopening their economies as the number of new cases start to slow. Hong Kong says the economy will contract by as much as 7% this year as the virus fallout adds to pressure from months of anti-China protests. The advanced first quarter GDP reading is due on Monday and may be worse than was seen during the financial crisis. Hong Kong has been in recession since the second half of last year, with tourism, retail, and entertainment all under severe pressure. The labor market in Singapore has seen its sharpest quarterly slump since SARS in 2003 as the city-state deals with the highest number of virus infections in Southeast Asia. Total employment, including foreign domestic workers, fell by almost 20,000 through March due to a decline in the number of expat workers. The unemployment rate hit 2.4%, its highest level since 2009. And Africa's largest wireless carrier is seeking to dismiss U.S. claims it paid the Taliban to avoid attacks. Families of U.S. service personnel killed or wounded in Afghanistan launched a case against a company last year, saying it paid money to the insurgents to protect its mobile phone towers. MTN says the suit targets the wrong defendants and is in the wrong court on insufficient evidence. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Sherry.
Right, we're getting breaking news at the moment. We are now hearing that Tyson Fresh Meats is pausing production at Dakota City beef plant, and this as they're now screening team members for COVID-19. This is a temporary pause in order to conduct deep cleaning and sanitization. This, of course, coming after President Trump just signed an executive order to force these slaughterhouses to remain open. Tyson Foods is the largest meat processor in the United States, and they had to close their plant in Kentucky, the latest close of a meat processing factory here in the United States, as we could potentially see shortages of meat, given that we are seeing more and more workers at these factories contracting the COVID-19. Tyson Fresh Meats pausing production at a Dakota City beef factory. Coming up next, Elon Musk and Tesla shareholders are dancing again after the latest quarterly numbers. But how long the music plays in 2020 is still a question. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience. Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
So what's the best new feature you're working on that's going to excite people in a year or two or something like that?
If I told you that, we would have to do the Men in Black thing.
Oh, okay.
So
You're watching Daybreak Asia. Let's get you a quick check of the latest business flash headlines. Boeing has announced plans for deep job cuts and reduced output amid the worst crisis in aviation history. Production of wide-body planes will be scaled back as customers shelve orders, with the cash cow 737 MAX returning from its grounding only gradually. The coronavirus has ravaged the aviation industry and travel demand, and Boeing aims to cut 10% of its workforce. That's about 16,000 jobs. Airbus is warning of the gravest crisis in aviation history after burning through almost $9 billion in the first quarter. Almost half of that came from a bribery settlement, but the severe fall in orders amid the virus pandemic has added to financial woes. CEO Guillaume Faury says Airbus aims to survive without state support, but needs as much help as possible from customers and suppliers as it can find. Well, China's top airlines slumped in the first quarter, and there are warning signs that the worst is yet to come as the coronavirus hammers demand for travel. Air China, China Southern and China Eastern lost a combined $2 billion through March and are operating at less than half capacity. Domestic flights have picked up, though, as the country eases restrictions, but international demand remains weak at best. Singapore Airlines says it's expecting, quote, substantial losses on jet fuel hedges in the year through March due to the enormous cut in flights because of the coronavirus and the collapse of oil prices. It says that means that it's now over-hedged on fuel consumption, and surplus hedges will be market to market as of the end of last month.
And we have breaking news out of SoftBank. They have revised their full-year financial results. They're coming out and saying that they're seeing full-year operating loss of 1.35 trillion yen. The estimated loss was for 116.8 billion yen. So this is a huge revision, and the loss to be much, much larger for the full year. We're talking about more than a trillion yen. The expectation was for around 110 billion. SoftBank also saying that there will be no changes to their financial policies for LTV and also cash positions. We'll get you more updates on that story as we get them. But of course, we have seen SoftBank suffering from big losses as some of their startup bets haven't really played out. Now they're saying that they're seeing 700 billion yen loss from investment loan commitments. For now, let's turn to Tesla. Shares surged after hours. The electric car maker reporting its first ever quarterly profit to kick off a year, but it's not all good news. Bloomberg News reporter Dana Hall covers Tesla, and she's with us from San Francisco. Dana, great to have you with us. Of course, another quarter of a huge cash burn, not to mention that they didn't give any forecast for the next few quarters. So give us your takeaway on what was important during this earnings report.
Well, it was a very positive earnings report. It was the third positive quarter in a row. But the big news now is that they just had the earnings call, and Elon Musk went on quite a tirade about the Bay Area's shelter-in-place orders. He called it fascist. He said that people should have their goddamn freedom. He's clearly very annoyed that Tesla's Fremont factory cannot resume production anytime soon. And, remember, Tesla just has two factories, one in Fremont, one in China. And so the inability to produce in Fremont really cuts into their ability to make cars. And if they can't make cars, they can't sell them. So that was the big news out of the call that just ended.
Dana, what are we expecting in terms of guidance of what the forecast might look like in the post, or I guess the immediate aftermath of these COVID-19 disruptions to demand and also production?
Well, Tesla didn't give any guidance. They said that anything that they said now would likely be inaccurate, and they would give guidance in Q2. But, I mean, their factory in Fremont is currently shut down. It cannot resume production anytime soon, and that's going to really crimp their ability to make cars. So, I think that what we heard on the earnings call with analysts was a very frustrated Elon Musk. But, after hours, the stock is performing high. I mean, this was a very good quarter for them. But going forward, the second quarter, they're going to face a lot of headwinds.
How well did they do in China?
They did not break out sales in China at all.
We have seen the growing sales volumes there and Model Y deliveries as well. So what can we expect in the next few quarters when it comes to what models we can see from Tesla and their deliveries?
Well, Tesla makes 4 cars, the Model S, X, 3, and Y. They are ramping up production in China, but that's it. I mean, you're not going to see any other car come out this year. The big focus is really on ramping Model 3 and getting the Model Y out the door.
What are we expecting when it comes to future cash burn then?
Oh, I mean, so Tesla makes money selling cars. Unless they can really ramp up production or shift production from the U.S. to Shanghai, they're not going to have any cars to move. I mean, their factory is shut down. I feel like people don't fully understand how significant it is that the Bay Area shelter-in-place order, which was set to expire on May 3rd, was just extended through the end of the month. So that's basically 2 out of 3 months of the quarter that Tesla is not making cars, and it's very difficult to just kind of turn a factory back on. It takes quite a while to ramp back up to pre-COVID-19 production volume. So the second quarter is really going to be where the rubber hits the road in terms of, their ability to just have any kind of regular cash flow coming in.
All right, Dana, thank you so much for that. Dana Hull in San Francisco with the latest on Tesla. That sort of surprise profit for the first quarter, but clearly looking beyond that to see the impact of the virus. We are just getting these surprise numbers out of SoftBank, of course. The preliminary net loss being reported of 900 billion yen. We had been looking at potentially a net loss of 750 billion yen, so that was a dent on expectations. That in terms of the details of the numbers, saying that the non-operating loss is now expected to exceed 1 trillion yen. 700 billion yen loss came from the investment loan commitment. There's no change to financial policies when it comes to the cash position. The full year revision, though, coming through on that Vision Fund loss, of course, as we've been speaking to at length. Sherry, SoftBank really suffering on the back of some of its high-profile investment failures like WeWork.
Yeah, let's stay with Japan because we are now getting breaking news. March industrial production numbers coming in month on month, a contraction of 3.7%, a smaller contraction than what was expected. Year on year, the preliminary numbers also a smaller contraction of 5.2%. Of course, the March numbers seem a little bit better than what was expected, but April could be far worse. We have heard from manufacturers, including Toyota, Toshiba, announcing suspensions of factories. Retail sales year on year contracting 4.6%. Month on month, a contraction of 4.5% in line with estimates. Plenty more to come on Daybreak Asia. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
forward, we remain resolute. Our objective is to curb the spread of this virus in Singapore, as is the objective of governments around the world. And we are sparing no effort in that regard. And that is also why we have extended the circuit breaker in Singapore till the 1st of June. And we think that with the cooperation of businesses and the population, we should be able to overcome this.
As is Warren, Singapore Minister for Communications and Information, we thank you for your insights this morning. Plenty more to come on Daybreak Asia. Keep it here with us. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
China's April PMIs are due out later today, and analysts expect a tiny pullback after last month's rebound that drove the index to pre-outbreak levels. Joining us now from Hong Kong is Serena Zhou, Mizuho Securities Vice President. Serena, great to have you with us. So what are your expectations for Chinese eco data today? And given that we have seen the majority of workers now return back into the manufacturing, back into production, back into factories, could we see a significant rebound going forward?
Oh, actually, our forecast for manufacturing PMI is below Bloomberg consensus at just 15. The solid activity rebound we saw in March has already lost its momentum as lockdown measures were adopted across the world. If you're looking at high-frequency data like coal used for electricity production and China's shipping index, you will see that actually there has been very, very limited improvement in manufacturing activity since end March because of some export order cuts in China.
So what does that mean then going forward for the second half? So if you're not seeing the rebound and you're seeing the rebound actually starting to fade, the momentum starting to fade, does that mean that it affects the rest of the year as well?
First of all, for the second quarter, I expect there can still be a lack of recovery in China's domestic consumption and also curtailed external demand because of the continued virus infections outside China. But for the second half, actually, I believe as China stabilized, as China's growth stabilized, and most people are less worried about getting infected outside, probably there will be more consumption, especially for offline shopping and services. So right now, actually, those well-known shopping malls in China's major cities are still seeing 70% less people than usual, according to Baidu Index. And if that number can resume gradually, it means those activities in China can really return to normal. And that's when China's economy started to stabilize.
So, Rena, with the MPC meetings now rescheduled to May, what are you expecting in terms of this balancing between economic recovery and preventing a second wave? And will they have to drop the GDP target for 2020?
Yes, actually, I think the Chinese government, by finally setting the date for the annual National People's Congress, it suggests that the government has already prioritized the task of bringing the economy back to normal. It's not really easy given the global number of new cases remain over 70,000 per day, and there still can be a second round of virus outbreak caused by imported cases. But so in that sense, I think the government can have to just balance between a lack of economic recovery and the second round of virus outbreak. This means any moves by the government to ease existing bans will only take place gradually, which can make a V-shaped recovery less likely over time. Actually, we think the government will drop its specific GDP target for this year. We only forecast 2.0 year-on-year growth for China's full year GDP, and we think it would be more realistic for the government to set a combined GDP target for this year and next year, and focus more on sustaining employment right now.
There, but thank you for joining us. Serena Zhou, Mizuho Securities Vice President, there with us ahead of those PMI numbers from China. We'll be continuing our coverage of the latest PMI readings later. We'll be speaking with Autonomous Senior Analyst Charlene Chu. Will be along with us on Bloomberg TV. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Facebook jumped in late trade after reporting an 18% increase in first quarter revenue, showing strong advertising demand before the COVID-19 pandemic hit marketing budgets. CFO Dave Weiner told us which sectors were under the most strain.
I would say we're seeing weakness in some of the logical categories like travel, auto. Where we're seeing strength is places like gaming, where people are driving app installs, e-commerce, where people are driving online conversions. So that gives you some of the flavor. It's pretty broad-based across both large and small advertisers, though. I wouldn't say it's concentrated. The impact, at least right now, is concentrated on small business.
How about geographically? Are you seeing regions performing better than others?
Well, if you look at if you look at our top countries by user, every one of those countries has some sort of lockdown measure in effect right now. So it's really pretty broad across countries. In terms of advertising regions, We do have an advertising business in China where it's an export-driven business, so we don't have users in China, but we do have advertisers in China who are trying to reach users outside of China. We did see that business, come off more quickly in early Q1, and we've seen a bit of a recovery in China. Some of that kind of maps to what I was talking about before with the verticals. A lot of those advertisers are in places like gaming and e-commerce, and those types of verticals are doing better. But we did see that more quick drop off in China earlier in the quarter.
95% of folks at Facebook are right now working from home. What's your timeline for bringing those people back to work, especially given that there will be some government guidance, but you could potentially choose to be even more cautious than government guidance?
Yeah, so I think we will be more cautious. We are blessed with being able to work from home and being able to operate relatively effectively. I don't think we're operating at 100%, but we've got 95% of our people working from home. We're able to, ship new code. We're able to moderate content. We're able to keep connected with our business customers. So we're able to do a lot of the essential functions without coming in the office. We do have a handful of employees who do have to go in, and obviously safety is the focus there. We've got to have people in our data centers, for instance. And so we are focusing on safety for those folks, but we're going to probably be a little bit more cautious. And part of that is, we can do our jobs from home, and we want to make sure that the shared infrastructure out there is available for people who, do need to be going into the office. So, we don't want to overload public transport and the like by going back too quickly on that front.
You recently did this $5.7 billion deal in India with Jio. Are we going to see more investments like that? Where, and will they be more like investments or partnerships?
Well, this is a very special, India's a very special market. This is a very special company who's done really great things to bring, hundreds of millions of people into the digital world. So Jio is really an exceptional effort. India is obviously a very important country for us. It's our largest MAU country, and it's been, a driver of growth for Facebook and WhatsApp for many years now. So, India is kind of a critical market for us in the long term. We were really fortunate to have the balance sheet to be able to make an investment like this in a troubled economic environment. So, we're pleased with that. And, we look forward to partnering with Jio platforms to help small businesses connect with our, WhatsApp, with people on WhatsApp and drive commerce and payments through that.
It sounded like on the call, though, that Mark indicated that, yes, you would be doing more of this. And I'm curious if you can shed any more light on regions or economies in particular that might pique Facebook's interest.
Well, I think Mark's talked about generally, WhatsApp and the power of that platform and doing more on the payments front with WhatsApp across the globe. So, I think there are certainly global opportunities to do that. But, this was clearly a very special opportunity and something that warranted, obviously, by far the largest investment we've ever made.
Facebook CFO Dave Wehner there speaking with our Bloomberg technology anchor Emily Chang. We will be watching DBS when it starts trading at the open in Singapore in just a few minutes' time. The lender has posted its first profit decline in 3 years. Bloomberg Intelligence senior financials analyst Diksha Gera joins us now from Singapore. Diksha, what do you make of these numbers? Were they worse than what you expected, and what does it mean for the full year?
Yeah, hi. Thanks a lot for having me on. Good morning, everyone. I think the numbers are bad, of course, and not surprisingly, bulk of this is coming from a surge in provisions. I actually anticipated a pretty healthy top-line growth, and that the bank has delivered on. The bigger hit was from the $1 billion this quarter that they've set aside for provisions. Now, the key takeaway for me is the 3 to 5 billion provisions hit that Piyush has highlighted, and the main issue is that how much worse the market will assume on top of this. Just taking away, what are the key headline numbers? I think the top line was great. Revenue was still up 13%. Pre-provision profit was up 20%, which is great. But I think those numbers will start looking weaker here on. And some of the key catalysts, of course, is how long the lockdown will last in Singapore. And China recovery, that will be a key catalyst for DBS particularly.
So what are some of the big top-line headwinds for DBS now?
So I think the provision side, they've given us some guidance, but the bigger concern now for us is also on the margin side. So Fed cutting rates to about 0, SIBOR falling from 1.7, almost 70 basis points just in March. That poses risks to its margins. The second one is vulnerability from markets-related income, and especially if trading flows weaken, there's deleveraging in the wealth portfolios. That kind of chips away at non-interest income. On the loan growth side, I think that may still hold up, and that's because the pace of repayments will slow down, and businesses could actually draw on credit lines to deal with the cash crunch that they're dealing with. So margins and provisions are still some of the bigger issues that we're looking at.
Deksha Gera, thank you very much. Bloomberg Intelligence Senior Analyst. And of course, we'll be looking forward to DBS starting to trade very soon. Still ahead, don't miss our exclusive interviews with the Fortescue Metals Group CEO, plus MasterCard's co-president of Asia Pacific, both coming up a little later. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
During these uncertain times, we remain committed
to providing the news and data driving global markets,
to make sense of this situation impacting all of us right now.
And while we may look a bit different,
we stand by that commitment.
We're here for you. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
I think Facebook's how we won in a lot of ways.
Running Microsoft was a ton of fun, and it was, it's kind of inspirational.
This is your weekly review of the most important business news and interviews from Bloomberg Television around the world.
It is 9 a.m. here in Beijing, Shanghai and Singapore. Welcome to Bloomberg Markets China Open. I'm Tom McKenzie.
And I'm David Ingles. We are counting down to the open of trade on the Chinese mainland today. Our top stories, markets across the Asia-Pacific extending those gains that we had over on Wall Street amid optimism about a treatment for the coronavirus. Oil futures are rebounding as we speak after dramatic declines.
President Trump sees light at the end of the virus tunnel. Project Warp Speed aims to drastically cut the time it takes to develop a vaccine.
Fed Chair Jay Powell talks of heartbreaking harm from the pandemic, saying that the fallout has brought the U.S. economy to an abrupt halt.
And David, we have some breaking lines in terms of China's April manufacturing data. PMI coming in at 50.8. That was below the estimates, just marginally. The estimates had been for 51. Still in expansionary territory, of course, after that terrible print in February. You got about 52 back in March. This is the April number. China April manufacturing PMI at 50.8. In terms of non-manufacturing, we're looking at expansion there, 53.2, above the surveys for services in terms of services and construction. Non-manufacturing PMI for the month of April, 53.2. Manufacturing PMI, 50.8. Let's talk about this data and get some more insights with our next guest. So we've been saying China has been ahead of the rest of the world in terms of virus prevention and in terms of easing up some of those restrictions. Our next guest says a full recovery does remain, though, an uphill battle. Charlene Chu is a senior analyst at research firm Autonomous and joins us from Washington. Charlene, thank you for your time this morning. Your reaction to this PMI data?
Well, I think we've had a lot of questions from investors over the last couple of months in terms of how can these numbers even be above 50 to begin with, given that everything has been shut down. But we need to remember that these are month-on-month figures, and what was happening in April was we were still opening up in China, and in particular Hubei province and Wuhan were opening up, and that really did trump the drag that we were seeing overseas and the collapse in demand. Now, we expect that in May, we are not going to be having that kind of uplift that we've seen in March and April in terms of reopening in China, and this collapse in overseas demand is probably going to become more forceful, and our outlook is probably for PMI to be lower, below 50 next month.
Charlene, excuse me, David here in Hong Kong. You know, almost right on cue, as you mentioned, external demand. The sub-gauge for new export orders on the PMI fell back to 33.5. Now, the external weakness is something that we are to expect anyway. I think my question for you, is there anything actually that Chinese authorities can do about that part of the economy?
To be honest, there's not a whole lot they can do in this environment. I mean, this is really about demand overseas collapsing due to lockdowns, and until these economies in the U.S. and Europe reopen, and reopen significantly, not on the margins, we are not going to be seeing demand coming back in China, and our expectation is that that will be happening at the earliest June, and probably more Q3 in terms of getting a real return to normal for that export sector in China. So we have got another wave of pressure on the Chinese economy that's coming, and I think that brief respite that we had in March and the first half of April is going to be meeting a new reality over the next couple of months, and this raises a whole host of questions about renewed pressure on small businesses, on unemployment, and the fact that to date we still don't have a very aggressive response from the Chinese authorities to the drag on growth.
Charlene, you've sounded the alarm multiple times on the debt story, and to be fair as well to the other side of that argument, it hasn't really been a big issue because we've had growth in China, which tends to obviously make people not pay that much attention to the debt story in China. That's really been sort of the narrative the last 10 years or so. That changes substantially this year because you don't have any growth. Are you confident that China can prevent that from becoming a market event?
I think the way you phrased it was very good, which is debt doesn't matter when you're looking at nominal GDP growth in the upper single digits or the lower double digits, which is effectively where we've been for the last 10 years, obviously volatile around that. But we are in a very different climate today. And I think if this coronavirus shock really is isolated to the first half for the entire world, and we can all get back to some semblance of normal. Obviously, we're not getting back to where we were in January, but even if we can get to some semblance of where we were, I think Chinese banks are definitely going to have some problems with asset quality, but it doesn't necessarily mean we need to be having any type of financial crisis. But if we're talking about a very prolonged situation where the world is going through different phases of rolling lockdowns for the next 18 months, and the manufacturer of the world, China, is hit by this in terms of just no external demand, then that is a very difficult climate for banks. And even before the coronavirus hit, we were getting questions from people about, is 2020 the year we're going to see a wholesale cleanup of small banks in China? Because as you know, we had our first 3 interventions in small Chinese banks last year, which are the first ones in decades. And the authorities have been signaling that there's several hundred banks that are not in great shape, and that was before the virus hit. So this is not a good mix, and I think these debt problems are definitely something that needs to be on the radar for everyone in a climate where we're talking about growth being under so much pressure, potentially for a prolonged period of time.
Charlene, to what extent can domestic demand here in China prove supportive, as it did pre-coronavirus? You're seeing officials here now issuing vouchers for people, but the PBOC in a survey suggesting that consumers are very cautious, particularly when it comes to their employment prospects and wages. Is the consumer story now dead in the water until at least the second half?
I think it really does come down to the employment picture and the nervousness that a lot of Chinese people have right now about their job prospects and their wage prospects. If the authorities cannot stabilize that situation, then we are going to continue to have this cloud hanging over the consumer in China. And on top of that, we had a pullback in February in consumer credit. It did rebound a bit in March, but I suspect it's going to be pulling back again here as overseas demand is collapsing. So we've got wage pressure, unemployment pressure. We don't have a good consumer credit picture. And by the way, households have actually been saving a lot more over the last year and a half since the U.S.-China trade war began. So that's not a great picture in our view in terms of consumer driving a recovery in China. But the most important of those ingredients is the employment picture, because without that, we're definitely going to have a consumption issue.
And it becomes a political issue as well. Charlene, thank you so much. Great stuff. As always, a pleasure to have you join us on the program. Charlene Chu, out of Autonomous Research, their senior analyst. Right, very brief look across these markets right now. So a couple of markets are shut today, so volumes, as to be expected, are going to be light. The Topics Index, there we go, 1.7% on the back of news that the BOJ's ETS buys will be tilted more towards the Topics Index as well. Overall, though, we entered the bull market, or re-entered the bull market yesterday in Asia. We are on track for the best month, calendar month, in 4 years. We're up 7% on the benchmark. Flip the boards. We'll talk about DBS a bit later on the program. Currency market story, dollar drop overnight. Here's the story, though, a little bit of a reversal as far as that is concerned. The Aussie dollar hitting its head on that 100-day moving average as well. And over in Europe, in case you missed it, Germany came out with updated forecasts on their economy, and they're expecting quite a substantial contraction there. You can read all about that. Bottom of your screen, that's about to come up as well. Very brief look across the commodity markets as well. 2% and 6% respectively for Brent in West Texas, in that order. 2 and 10 both down about 1%, so no change as far as the steepness or the flatness of the curve, if you will, is concerned. We'll leave the markets there for now. Karina Mitchell's with us in New York, and she has an update of your first word news. Karina.
Hey, David. Industrial production fell for a second month in a row in Japan as the coronavirus increasingly disrupts global supply chains and demand. Factory output dropped 3.7% in March, following a smaller decline in February, although the fall was smaller than economists had expected. A separate report shows retail sales slumped 4.5% from the previous month. And Japan's 47 prefectures are set to ask the government to extend the state of emergency as coronavirus numbers continue to rise. Tokyo's Yuriko Koike said the situation remains severe there. Unemployment claims are surging in Southeast Asia, with almost 9 million people registering for aid in Indonesia. And the labor market is slumping in Singapore as well, amid its sharpest contraction since SARS in 2003. And Hong Kong says the economy will contract by as much as 7% this year as the virus fallout adds to pressure from months of anti-China protests. The advanced first quarter GDP reading is due out on Monday and may be worse than was seen during the financial crisis. Hong Kong has been in recession since the second half of last year, with tourism, retail, and entertainment all under severe pressure. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Tom.
Still ahead on the show, we're going to have more on the markets, and Loop Ventures co-founder Gene Munster joins us to discuss Tesla's earnings. We've had some spicy comments from Musk and what he expects from Apple. Plus, we asked MasterCard's APAC co-president how the pandemic is affecting the payments business. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience. Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Welcome back to the program. Let's talk about the Fed. U.S. GDP was also out overnight. So Jay Powell made it crystal clear that near zero interest rates and the special lending programs are pretty much here to stay as long as needed to fight what he calls or describes as the heartbreaking economic damage from the pandemic. But he didn't stop there. Let's bring in Kathleen Hayes, our global economics and policy editor. Kathleen, it's not about wait and see anymore, really. It's whatever it takes and more.
curious, David. You know, this is interesting because if you look at where the market was kind of tilting, investors, traders, like, what's Powell going to signal? You know, looking down the road, everybody's wondering about eventual rate hikes and that kind of thing. But basically, what Jay Powell says, he thinks the economy may need more help. He says forceful measures to contain the crisis have halted the economy. He, in fact, said the current rate stance is appropriate. He's going to keep it in place till there's a solid recovery underway. He said it looks like there may be more to do. Let's listen to what he said at the press conference.
Congress has also reacted quite aggressively and strongly with the CARES Act and other laws, several other laws, and that's appropriate. With enhanced unemployment insurance and the Paycheck Protection Program, we've seen an extraordinary, historically large reaction. But I would say that it may well be the case that the economy will need more support from all of us if the recovery is to be a robust one.
More from the Treasury Department, possibly more from the Fed. Of course, this led to questions about there's a lot of money being spent. What about the deficit? What Jay Powell said, this is not the time to worry about the federal debt. Basically, he's saying you pull out all the stocks. You try to prevent people from losing their jobs who may detach from labor force and never get back. Small and medium-sized businesses to close who would have been perfectly healthy and lose that part of the economy as well. He says the virus shock is extraordinary, unlike anything he's seen. We're still putting out the fire. We'll be at it for a while.
Yeah, Kathleen, and of course the US economy shrank in the first quarter. Not a big surprise, but Powell was talking about an unprecedented GDP drop in the second quarter. How bad is it expected to get?
Well, let's start with just how bad it was in the first quarter, as you know, the virus and the shutdowns were just getting their way in March, down 4.8%. So the 11-year expansion is over. The recession has begun. Let's jump into the terminal. And you can see that this is the worst number since 2008, when we were just entering to the deep and long financial crisis. Consumer spending, in fact, down nearly 8%, 7.6 annualized in the first quarter. And let's remember, when you look at U.S. GDP numbers, you never get a negative number. You always have positive personal consumption growth. Now you have this big, big drop. So let's look ahead to the second quarter, which Jay Powell, yes, said we'd see an unprecedented drop. In fact, Bloomberg Economics is looking for a 37% quarterly annualized drop in GDP. Can you imagine? In fact, Unicredit is looking for a drop of 65%. I was just talking to our chartmeister, Stu Hawkins, and he says it's going to blow out the chart when that has to be printed. But, you know, think about it. This is why Jay Powell is talking about building a bridge. The valley of the virus is very deep. It's a chasm. Can you build a big enough bridge with spending money, all these programs, to help us get across, right, to the other side where we can start growing again? This is the big question. But Jay Powell was eloquent. He was clear. You know exactly what's on his mind. And it's, again, it's doing what needs to be done, and that's what he's going to do.
Kathleen, thank you very much indeed. Our global economics and policy editor, Kathleen Hayes. Now, coming up on the show, a US drug trial spurs hopes that we are closer to finding a coronavirus vaccine. That's even after earlier results from China showed Gilead's drug failed. Details on that story next. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
The U.S. government's top infectious disease expert says the clinical trial of Gilead's potential COVID-19 treatment shows promising results, in fact, contradicting findings of a separate Chinese study. Now, that actually helped send U.S. markets soaring on Wednesday, despite, well, what we talked about earlier, bad news on the economy. Have a listen.
The data shows that remdesivir has a clear-cut, significant positive effect in diminishing the time to recovery.
Right, let's talk more about this with our science and health reporter, Robert Langreth, joins us out of New York right now. Rob, thanks for coming on the program. Good morning from Asia. It looks like, though, the jury remains out still on how well this drug actually works.
Yeah, we don't yet, we have the kind of announcement from the NIH and the press release from, from the NIH and the announcement at the White House from Fauci that this, this preliminary review of this trial reveals that it speeds up the recovery from the virus, and there may even be some hints that it improves mortality. But this is like a press release essentially, and none of this data has been published in a medical journal or vetted by outsiders. So it's very preliminary, and we don't really know very many details about what they say they are finding. And as you said, there's also a separate Chinese trial, a much smaller one that was published today, and this was a trial in China in severe patients that was stopped short of the number of patients they expected to get in the trial because they couldn't, the epidemic slowed down in China and they weren't able to get enough patients. But what it found was they weren't able to show that the Gilead drug, had effect in the small number of patients in China. And so, the question you could debate is whether is that over the fact that just couldn't get enough people, or, what is the difference between, these two results. So there's sort of dueling results out there, and it's very complicated, and we, don't have complete data sets yet. It's sort of, especially with the U.S. trial, sort of science by a press release right now, and we'll know a lot more in the next, few weeks. But already, Gilead is in detailed talks, with the FDA over a potential, emergency approval, and we'll see what happens there.
So, Robert, based on all of that, what is the time frame then for a potential treatment?
Well, if the U.S., if the FDA introduces some kind of emergency approval, I mean, Gilead has been working like basically around the clock to manufacture as much as possible of this drug. So they do have, some doses on hand that they could ship, right away to patients, but probably, not enough, for all the patients that would need it. And they are hoping to try to get, more than 1 million doses, and not doses, I'm sorry, enough quantity, a supply for more than 1 million patients, but that's by year end, because this is a very hard to produce drug. So if this is approved, and if the people agree that these, that these trials are indeed, net positive, and doctors want to use it, and they're going to want to use it because there's nothing else out there. So even if it's a small effect, they're going to want to use it. One problem is going to be, the demand is going to outstrip supply initially.
To that point, Donald Trump is looking to speed up the development of a vaccine. We're talking about Operation Warp Speed here. Tell us more.
Well, yes, there is apparently an effort in the White House that's is called Operation Warp Speed to speed up drug development. We don't even know kind of a lot about this right now. They're styling this as sort of a Manhattan Project style effort to cut the time you need to develop a coronavirus vaccine and make 300 million doses. But what's not clear about this is whether this is kind of a new branding on kind of essentially what was already going on already, which is manufacturers are already trying to speed up their manufacturing to make millions and millions of doses as fast as possible and find ways to cut short trials. So, what's not really clear is that what are the new parts about this and how much of this is kind of fancy branding on kind of a bunch of efforts and collaborations were already going on.
Rob, thank you. Robert Langreth, out of New York, our science and health reporter. Just minutes away from the open of the Chinese mainland markets. A kind reminder, South Korea, Vietnam, and Hong Kong are closed today, so we don't get it open in a couple of minutes or so here. First and foremost, stronger fixing out of the PBOC. Also, we had the PMI numbers here out as well. So reversal down in dollar China, a little bit of strength coming through there now in the offshore Chinese currency as well. Flip the boards and have a look at what else we're tracking here as well. I think we have some of these big earnings out of Singapore, which we'll talk about in a couple of seconds. Here's the PMI numbers out earlier on. Yep, there we go, 50.2, 33.5. That second bullet is what you want to be paying attention to, quite frankly here. It might get buried in a lot of the data here as well. Yes, it's expansionary when you look at the headline numbers, as with most, by the way, of these submeasures. But again, that second point is really what highlights the fact that China's external trading partners are probably seeing a little bit more pain, might be pushing back that recovery period as well. And just very quickly here, DBS was out with earnings, out with quite a substantial estimate of where they think credit losses are about to go in the next couple of years or so. So 1 billion was what they booked, 3 to 5 is what they are expecting moving forward there as well. Newcrest Mining was out with plans here to raise about $1 billion Aussie dollars in an equity sale as well. And of course, UOB and OCBC are due out with earnings next week, and perhaps DBS out with their earnings as well. Might be perhaps a clue of where those two are set to report here as well. There's lots more coming up. The Chinese mainland open, plus of course the Philippines. Keep it here. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Right, happy Thursday. If you're joining us across the region here, Shanghai, beautiful day, 26 degrees Celsius there. So really, spring has really come. Has spring come though when it comes to the economy? There are some conflicting signals out of the PMI numbers, with the headline numbers saying yes, but parts of the externally oriented sectors are perhaps saying that Dongtian is Haizai. All right, there we go. 24 seconds to the open of the trading session there over on the Chinese mainland town.
Yeah, and some mixed views as well on that PMI, as you're alluding to, where our MLive team's suggesting that maybe the May numbers are going to be positive again. But Charlene Chu, of course, who we spoke to from Autonomous, saying she thinks it could fall back into contraction next month. We did have it still in expansionary territory, but as you point out, it's the export numbers, those new export orders that look concerning about that external demand, of course. Maybe it puts pressure on policymakers here to step up the stimulus. That is something certainly that traders are looking for. Here we go, the CSI 300 in line with what the futures were pointing at, up 0.4%. Similar territory for Shanghai. Shenzhen is looking relatively strong, up 0.7%, as are the small caps in positive territory, up nearly 8%. The currency has strengthened somewhat. It's up almost 0.2% in the session in terms of the offshore yuan, currently at 7.07. a slightly stronger fix than what had been expected. And we can move it on. We should be looking at the currency right now, 7.07, as I was saying, offshore. And then we can move it on to some of the airlines, because that is the big story as well in terms of some of the earnings story here. Another big week, of course, for earnings. The airlines, though, posting losses in the first quarter, not a big surprise. We're going to be speaking to an airlines analyst shortly. But Air China, they posted a loss of almost 5 billion yuan in the first quarter. China Eastern, almost 4 billion yuan, and China Southern, around 5.5 billion yuan. We have had some restrictions, by the way, here in Beijing East, so we may see a pickup on airline travel over the next 4 or 5 days. It is the May holiday here in mainland China. David.
Yeah, and are we going to, I guess, see the early signs of a new normal when it comes to visiting a lot of these touristy places, airlines, trains, what have you, during this long holiday that's coming up here? So we are on holiday here in Hong Kong, by the way, so we're also shut tomorrow. So long weekend as well. We can talk about the weekend, pubs, beaches, hikes, and everything some other time, not here. All right, 5,700 on the Philippine composite here, 1% to the upside here. Generally speaking, Asia's been done very, very well so far this month. In fact, we're up 7% on MSCI Asia, which actually, if you go all the way back to 2016, is the best month since March of that year as well. Taiwan closing in on 11,000. Malaysia's also there. We got 0.9 of 1%. Bottom of your screens, you might see that as well. March credit to business data out of Australia here. Consumer rising 1.1% month on month. Very quickly here, flip the boards, and yeah, there we go. U.S. futures up. Well, I'm being generous. Two points to the upside here. Dollar yen's basically flat. Brent crude, 4%. That's expiring, by the way, today. And year's 10-year yield, 19 basis point measly there, above zero. Tom.
Yeah, let's get more on this airline story now. As we were saying, China's 3 major state-owned airlines, of course, took a big earnings hit in the March quarter with a total combined loss of about $2 billion. However, there are signs that maybe the worst could be over. Let's bring in aviation consultant Brendan Sobey from Sobey Aviation. Brendan, thank you for your time this morning. Give us your take on these earnings. What does it tell you about the future, the second half maybe, for some of these airlines? Are we starting to see a pickup in demand?
Yeah, I mean, there has been already a pickup in domestic demand starting in March. But the pace of the recovery has stalled a bit in recent weeks, and the indications are that that this May holiday period won't be that strong, won't be as strong as maybe some people were hoping or expecting a few weeks ago. What's happened is the business travel has somewhat resumed, but the leisure travel hasn't. People are just not comfortable traveling yet, and that will take some time. But then, generally speaking, China is still much better off than the rest of Asia Pacific. Even with domestic traffic down about 70% in April, that's a lot better than any other market in Asia Pacific. And the worst was the first quarter, while for the rest of the airlines in Asia Pacific, the second quarter will be the worst quarter. And we'll see a moderating losses probably for the rest of the year. Definitely we'll still see losses, but I think it's safe to say the worst is over. Just this domestic recovery might be a bit slower than some had hoped in the March month and in the second quarter.
How do you expect the virus to shake up and reshape China's airline industry that had been on course to become the world's largest airline industry? Are we still aiming and looking at that goal? Are they going to have to cut some routes? Are they going to have to reprice? How does it affect the broader industry in the medium to longer term?
I mean, I think in the long term, it's still the same. I mean, the fundamentals are good. The outlook for China is good. The traffic will return eventually, including international. So international will not return really this year. It might not return until next year or 2022. But the outbound China market, which is the Chinese going overseas, which has really picked up a lot in recent years and benefited a lot of foreign airlines as well as the Chinese airlines, as well as the tourism industries in many countries. Particularly in Southeast Asia, but also in Europe and North America and Australia, that will return eventually, and the center is still expected to be China as when growth returns, and that's why the Chinese airlines remain a good story. They have support from the government. They're not hedged. They have a huge domestic market that accounts for 2/3 of their revenue, and that will kind of hold them over a little bit better this year until we have the international recovery. And the government support is really key as well, because, like I was just mentioning, because other airlines around the world that don't have that necessarily that same kind of support, and some of those airlines, might struggle or might even collapse. While in China, I think even the private airlines will have government support and will be able to raise equity or improve liquidity to get them over this, because they do have a good long-term growth story and a good long-term story generally.
Brendan, David here. You can't help but think that, given the fact that you might have deep pockets in China and you also have cheap assets outside China as well. Talk to us about the potential for consolidation, acquisitions, in fact, here. Just, I guess, for argument's sake, which are there specific routes, specific assets, specific airlines, if you could name names, that might complement some of China, some of these big airlines in China that they might be looking at perhaps to purchase?
I don't think that's really the short-term focus. A lot of people have been talking about consolidation in many markets around the world, and surely there might be some airlines that exit or get new owners, but the new owners won't necessarily be other airlines. The airlines really have to focus right now on their own situation and their own markets. In China, you could see some domestic consolidation. There's still a lot of uncertainty about the fourth largest group, which is the H&A group, which has Hainan Airlines and some other airlines throughout China, as well as Hong Kong Airlines. And so there could be some consolidation there within China. In terms of Chinese airlines buying overseas airlines, we've seen a little bit of that over the years. I think in the long term we could see that again. We could even see there's some speculation about maybe China making a move on Embraer now that Boeing has kind of killed that deal, quite controversially just a few days ago. So long-term, definitely, but I think this short-term situation, I think the hype about mergers and acquisitions is a bit overblown. I think right now airlines are just focused on trying to have an exit strategy from this crisis and to survive this crisis in the meantime. A lot of them don't have the will or of course the capital to pursue acquisitions right now.
Yeah, Brendan, we got to leave it there. Thank you for coming on the program. Of course, we'd be glad to talk to you again. It's certainly an ongoing story, and hopefully for the industry itself and just the tens of thousands that they employ, we can get out of this fairly quickly and permanently, I guess, less permanently unscathed. Let's put it that way. Brendan Sobey there from Sobey Aviation, joining us live out of Singapore. Right, now we had earnings out of some of the biggest tech companies over in the U.S. here. Facebook, good one here to note and start with here. 18% increase in first quarter revenue, showing advertising demand was strong before the pandemic hit, and it says business was steady in the first weeks of April, sending the stock surging. Facebook sales came in $17.7 billion for the March period. The results covered just a few weeks in the month when lockdowns began to hammer the global economy.
And Microsoft quarterly sales and profit rose, buoyed by demand for internet-based software and cloud services to accommodate that shift to remote working. Net income through March climbed to almost $7 billion, while sales rose 15% to $35 billion. Profit came in at $40.40 a share, topping analysts' forecasts of $1.28. Shares rose in late trading.
Right, Tesla soaring after
Tesla
reporting its first ever quarterly profit here. Yeah, let me pick up on that. Elon Musk, by the way, he's tweeting out, so just have a look at that. But broadly speaking, when you look at the company here, quarterly profit at the start of the year, it burned through, though, cash yet again here, backing away from guidance as to how the rest of 2020 might actually look. Really similar theme across many other corporates. But investors welcoming the news, generally speaking, but the call was enlivened here by Elon Musk ranting about the virus restrictions that have kept workers at home and put Tesla's streak at risk. He said, quote, "This is fascist, this is not democratic, this is not freedom."
To say that they cannot leave their house and they will be arrested if they do, this is fascist. This is not democratic. This is not freedom. Give people back their goddamn freedom.
Never a dull moment with Elon Musk. And we're going to have more on Tesla's earnings and preview Apple with Loop Ventures co-founder Gene Munster. That is at 10:30 Hong Kong time.
Yeah, coming up here, so we had the manufacturing numbers here. We have the other survey here, the Caixin PMI numbers out of China as well. And joining us to discuss the investment climate and business conditions there on the Chinese mainland, Deckert China managing partner Tao Jingzhou will be coming on shortly. This is Bloomberg.
Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience. Here's the thing about managing multiple clouds for your business.
Things can get a bit cloudy for you.
But now, there's the Dell Technologies Cloud. A single hub for a consistent operating experience.
Welcome back to the program. You're watching Bloomberg Markets China Open. Now, speaking of Beijing and Washington, we've also seen on the M&A space really a drying up of transactions here as firms focus on simply their own survival. So, question is, what's the outlook? Joining us on the line to talk about that is Tao Jingzhou, Deckert China managing partner and an international arbitration lawyer who, in fact, has advised many foreign companies in China. Comes to the trade war, big story there. He has lots to talk about when it comes to that as well. Thank you for joining us on the program, sir. Good morning. I guess I first want to understand, from your perspective, what are you getting as far as the reopening of the economy is concerned? Are you seeing more businesses come online? Are you seeing, busier transactions from your point of view?
Yeah, I think the resumption of the production is really staged in different provinces of China. And for example, export-related sectors other than PPE have very limited resumption because they are really relying upon export. Also, the travel restrictions also have a major impact of a resumption of the production. It also sometimes depends on the attitude of local officials, because some officials do not want to put their political career in risk because they don't want to have a second wave of a virus spread. So that's why they are kind of very cautious to reopen for business.
And one of the chief concerns
Beijing, for example,
you bring up...
Sorry.
Go ahead.
Yeah, I think, for example, in Beijing, you see very limited resumption taking place. In the service sectors, some hotels remain closed and others opened. Some restaurants opened, others still closed. I think that the full resumption in Beijing sector, at least, will start only after the closing of this, what in Chinese we call Lianghui, meaning the Congress of CPPCC and the National People's Congress at the end of the May. So my forecast is that in Beijing sector, at least, the resumption will start only in June.
Tao, I'm just going to interrupt briefly because we've got some data breaking across the terminal now. The Caixin, this is the private survey, China manufacturing survey for the month of April, 49.4. That was below the survey, so in contractionary territory. You had a print the previous month, by the way, in March of 50.1. So it slipped back into contraction. That is the private survey. We had the official numbers, of course, in terms of the manufacturing survey out at the top of the hour, where we saw a print of 50.8. So some divergence there between the official and the private survey. Not hugely unusual. We're going to bring it back now